Good morning. Today, we're diving into a story that's sending shockwaves through the financial world. A story that's not just about numbers, but about trust, risk, and the delicate balance that keeps global markets steady. In the world of global finance, some decisions echo far beyond the trading floor. They ripple through boardrooms, government offices, and even the lives of everyday people who may never set foot in a stock exchange. Last week, AXA Investment Managers, a powerhouse overseeing a staggering $879 billion in assets, made headlines across the globe. The reason? They decided to sell off a significant portion of their UK government bonds, an asset class long considered a bedrock of stability. This wasn't a routine portfolio adjustment. It was a bold, calculated move. AXA halved their exposure to UK gilts in a single stroke. The message to the market was unmistakable. Something fundamental had changed, and caution was now the order of the day. UK government bonds, known as gilts, have a reputation for being ultra-safe. For decades, they've been the go-to investment for those seeking security and reliability, especially in uncertain times. So when a financial giant like AXA suddenly dumps a large chunk of these supposedly rock-solid assets, it sends a jolt through the entire financial ecosystem. Investors, analysts, and policymakers alike are left scrambling for answers. What could have prompted such a dramatic shift? The answer lies in a sudden and unexpected loss of faith in the UK government's financial direction. This loss of confidence was triggered by a surprise policy announcement from Downing Street that caught markets off guard and upended expectations. Finance Minister Rachel Reeves had just scrapped a widely anticipated income tax hike, a move that many believed was essential to stabilizing the nation's finances. The decision rattled markets, which had been counting on the extra revenue to shore up the government's budget and maintain investor confidence. Now, AXA's dramatic exit has sparked fierce debate among economists, investors, and politicians. Uncertainty hangs over the UK's economic path, with questions swirling about the government's next move, the stability of its finances, and the potential ripple effects for global markets. One thing is clear: the world is watching, and the stakes have never been higher. To understand AXA's decision, let's rewind. For months, markets expected Finance Minister Rachel Reeves to announce an income tax increase, a move seen as essential for shoring up public finances. Investors had already priced in this tax hike, planning around it. But on November 14th, the government abruptly reversed course, scrapping the tax rise and stunning the financial world. This U-turn left investors questioning how the government would balance the books without new revenue. The sudden change created a credibility gap, making the government's fiscal plans look less believable. Investors need predictability. Instead, they got confusion and doubt. The market's trust in the government's ability to manage debt was shaken. Let's break down government bonds and why they play such a crucial role in the UK's economy. When the government needs to raise money, whether to build new schools, fund the NHS, or invest in infrastructure, it issues bonds. These bonds are essentially IOUs, sold to investors with a promise. The government will pay them back on a set date, and in the meantime, pay regular interest. Investors, which can include pension funds, insurance companies, or even individuals, hand over their money in exchange for these promises. In the UK, these government bonds are known as gilts. They've earned a reputation as some of the safest investments in the world, largely because the UK government has a long and reliable history of repaying its debts. This trust makes gilts especially attractive to large institutions that need stability, like pension funds and insurance companies, who rely on predictable returns to meet their future obligations. The safety of gilts is vital for millions of people. Pension funds, for example, use gilts to help ensure retirees receive their promised income. Insurers use them to back the policies that protect families and businesses. When gilts are stable, these institutions can plan for the future with confidence. But there's a catch. Bond prices and yields move in opposite directions. If investors lose confidence in the government's ability to repay, they may demand higher yields, which means the government must pay more to borrow. This can happen quickly, as prices fall and yields rise, making it more expensive for the government to raise funds. Recently, when a major investor like AXA decided to sell off a large amount of gilts, it pushed prices down and yields up. This sudden move increased the UK's future borrowing costs, putting pressure on government finances. Higher interest payments mean the government has less money left over for vital public services, like healthcare, education, and social care. Every extra pound spent on debt interest is a pound not spent on the things that matter most to people's daily lives. So the actions of big investors and the health of the bond market have real, tangible consequences for everyone in the UK, from city workers to families at home. Understanding government bonds helps us see how financial decisions ripple through the entire economy. Inside AXA, the decision to sell wasn't just about numbers on a spreadsheet. It was about a fundamental loss of trust in the government's ability to manage the economy. For a global financial powerhouse like AXA, trust is everything. When that trust is shaken, even the most carefully laid investment strategies can unravel in an instant. Nicholas Trindade, a senior fund manager at AXA, explained that the government's sudden and unexpected policy reversal sent shockwaves through the financial sector. The fiscal plan, once seen as credible, was now under a cloud of doubt. Investors like AXA rely on governments to provide a stable and predictable environment, and when that's lost, confidence evaporates quickly. Before the government's U-turn, AXA had been heavily invested in UK government bonds, or Gilts, seeing them as a safe and reliable asset. But after the policy shift, AXA rapidly retreated, moving to a neutral position. This wasn't just a minor adjustment. It was a dramatic change in strategy, reflecting deep concerns about the UK's fiscal direction. Investors crave predictability and stability. The government's abrupt shift signaled not just a change in policy, but the potential for more erratic and unpredictable decisions in the future. This kind of uncertainty is toxic for markets, making it nearly impossible for investors to plan ahead or feel secure in their positions. By ruling out a tax hike, the government effectively removed its most credible tool for balancing the books. Without the option to raise revenue, questions mounted about how the government would fund its commitments and maintain fiscal discipline. This move only deepened the sense of unease among investors. AXA's decision to sell was more than just a portfolio adjustment. It was a financial protest, a clear message to policymakers that the risk of holding UK debt had jumped overnight. The market reaction was swift and severe, with other investors quickly following suit. For AXA, the priority was to protect their clients from the volatility that comes when confidence in government policy is shaken. Their actions were about safeguarding investments and reassuring clients that their money was being managed prudently, even in turbulent times. In the end, AXA's move was a defensive strategy, a calculated response to a single but seismic policy change. It was a reminder that in the world of finance, credibility is everything. And once it's lost, the consequences can be immediate and far-reaching. Not everyone is following AXA's lead. Royal London Asset Management saw the drop in bond prices as a buying opportunity, snapping up gilts at higher yields. Their bet? The Bank of England will soon cut interest rates, making existing bonds more valuable. Fidelity International also remains positive on UK bonds, focusing on economic fundamentals rather than political drama. Some, like Allianz Global Investors, share AXA's concerns but still prefer gilts over alternatives, believing market pressure will force government discipline. These differing views show that even in turmoil, some see risk while others see reward. The market is split, some betting on recovery, others on more trouble ahead. This diversity of opinion is what keeps markets moving. Two key terms: fiscal headroom and market discipline. Fiscal headroom is the government's financial cushion, the buffer before breaking its own debt rules. Investors wanted a big cushion, ideally $20 billion, to weather economic shocks. The scrapped tax hike shrank that buffer, making the government's position riskier. Market discipline means investors can punish reckless policies by selling bonds, raising borrowing costs, and forcing governments to act responsibly. Some investors trust this market pressure to keep the government in check. A smaller safety margin means even a minor downturn could spell trouble. That's why these concepts matter so much to investors and policymakers alike. Let's hear from the decision-makers themselves. Nicholas Trindade of AXA called the government's plan a lot less credible, a blunt rebuke from a major investor. Ben Nicol at Royal London, despite buying bonds, questioned the Chancellor's reliability. Ranjiv Maan at Allianz agreed the U-turn hurt credibility, but believes market forces will keep the government disciplined. Despite different actions, selling, buying, or holding, all agree. The government's credibility has taken a hit. These voices reveal a strained relationship between the government and investors. Trust is eroded, and the government must now work to restore it. The stakes are high. Credibility directly affects the UK's financial future. AXA's decision isn't just financial theater, it has real-world effects. When big investors sell UK bonds, the government's borrowing costs rise, just like a higher interest rate on a risky loan. More money spent on interest means less for hospitals, schools, and infrastructure. The government may face tough choices, cut spending, or find new ways to raise revenue. Rising gilt yields also push up mortgage and business loan rates, squeezing households and slowing economic growth. Pension funds, major holders of gilts, face more volatility and uncertainty. A loss of investor confidence can ripple through the entire economy. The health of public finances and everyday wallets are closely linked to global investor trust. So, what's the bottom line? AXA's bond sale is a stark reminder. Government credibility has a real price. The UK's policy U-turn made borrowing more expensive, with potential impacts on public spending, taxes, and personal finances. Higher borrowing costs could mean tighter budgets or higher taxes down the line. Mortgage rates, loans, and even pensions are affected by these market moves. While some investors see risk, others see opportunity, reflecting deep uncertainty. The coming weeks are crucial as the government tries to restore trust and stabilize markets. The outcome will shape the UK's financial future, and your own.